Good evening, everyone. Time for another silver update. This is the 2-hour chart of silver provided by netdania.com. You can click on the link below. And drawn a couple of trend lines in here. One comes down to about 29.50. The one we're currently testing comes to about 28.30 or so. Looks like if we get to 28.50, it'll be a break of that trend line. So I had some trend lines on the blog the other day, and these change as the prices move. So it looked like I did a chart called breakout or fake out, and we've had a few fake outs in the past. This one looks like it may actually be a breakout. You can see we're rounding up here. Normally the MACD, which you can see hit an overbought position at the top of this little rally that we did in the last few days, but has kind of started to correct and started to round up. So we could get one of these here where it comes up a little bit and then it rounds up and goes more, and you can see the price move that we got out of that. So if we got one of those here, could we get something like this, catch up to that? Maybe. The point we were watching real closely, of course, these two trend lines, and then the price around 30 is going to be really important, because you can see that it was this dip down here and rallied, and that was the drop-off point that took us down to the 26 test, most recent. And then with a rally after that 26 test, you can see we got right up to that 30 point and sold off. So for us to form kind of a W bottom or something like that, it's going to be really important to get the price action up through this 30 again, and that may be a significant bottom at that point. So we'll watch it next couple of days and see if we get through those key points. Wanted to move over to the question of the night. Before I do that, I wanted to look at the some coins, the Dragon especially. Now, I'd covered the 2012 2-ounce Dragon. I told you when I bought that, I don't remember, we were in the 26s. That was my pick at that time. My pick is usually based on what's left when we're dropping. And my guess was that they'd run out. They did run out, and then they got 500 more. They ran out again. They got 500 more. They ran out again and got 500 more. Now they're out of stock. So I don't know how that works with the Perth Mint and how fast those turn around. You can see that that's the 2-ounce. Oh, that's the Dragon with the red box. I'm sorry. They're both out of stock. The 1-ounce actually dropped down. APMEX dropped a 1-ounce down to $65 for like a week. I saw it down there, and then it's back up to $75. So they're really reluctant. They still got about 7,500, so they're not selling them because that premium is just ridiculous. So at some point, I think they're going to have to come down on that premium. Now, the 1/2 ounce, they had a ton of those in, and you can see they only have about 12.75. I don't know if the 1/2 ounce are going to end up out of stock or not. There's a lot of coins that I bought. The Tigers here, well, that's the 10-ounce Tiger. But the 1-ounce Tiger, when I bought that one, it went out of stock, and it stayed out of stock. They got 59, but they're all the way up at $80. That one went out of stock and just stayed out of stock from that point on. So sometimes you'll buy them and they'll go out of stock. Other times you'll buy them and they'll get them back in. It's just kind of the luck of the draw. If we go over to Gainesville, you can see they're out of the 1/2 ounce Dragon. They are also out of the 2-ounce Dragon as well. So it may be that those 2-ounce Dragons are drying up. That was my bet. That was my hope that it would kind of turn into a semi-numismatic play. I'm pretty happy about it because they were $32 an ounce. 32 because the coins were 64, 66 I think when I bought them, and that was 32. So 32, 33 an ounce, and we're now at 28, 23. So if you're lucky enough to pick a bottom, bottoms are usually pretty dramatic. You buy something down here $26.75, and all of a sudden the price is back up at 30, then you kind of pay for that premium. That's another reason why I really like to buy the dips, is because it gives you the ability to soak up that premium. You can get a little bit nicer coin than you could have if you have good timing. So let's go over to the question of the night. This is from Silver to the Moon. It's not really a question, it's kind of a rant, but I'm going to go ahead and go through it because it's interesting. He says, if JP Morgan are behind the short in silver, who's behind the longs? Someone who's very bearish about silver said they subscribed to Ted Butler to see what all the fuss was about. They said, to see what all the fuss was about and cost $35 a month. I don't subscribe to Ted Butler. I don't know if this is true or not, that it's $35 a month. So I'll take their word for it. And I found out that the fuss was about nothing, really. I emailed the numpty, is he talking about Ted? I don't know. And asked him why he was only bothered about who was short, but never about who was long. Somebody has to be long the contracts that are being sold by JP Morgan and whoever. The answer I got was quite pathetic, really. He didn't seem to want to discuss who was long. Look at the most recent Commitment to Traders report. There are about 98,000 short contracts, 98,000 long contracts. So if JP Morgan and one or the others are the bulk of the shorts, who are the longs? Nobody ever seems to want to answer that question. And there's a link to the CFTC. And I asked him, who do you think are the longs? JP Morgan probably, or whoever is behind the contract sold by JP Morgan. Remember, actually, this will no doubt be news to most of you loons, because JP Morgan is the seller of the contracts, and the research done by Butler shows that they are. It doesn't automatically mean that is their position. Anyone who's not registered as a floor trader on the COMEX or any other futures exchange has to use the floor trader, bank, or broker or local to buy and sell for them. The trades will be registered as done by the floor trader, not the entity behind the trade. So, what's the point of all this rambling here? Well, first of all, in Ted Butler's defense, I remember Ted talking a lot about the commercials, the Raptors. A lot of times he's addressing people getting taken to the cleaners by the shorts. But the main point, and the one I want to address, it really important key point, is that is true. When you have in a futures contract, you have the same number of short contracts as the same as a number of long contracts. It's by definition so, because when you take a position betting against a commodity, someone has to take the other side. This is a bet. You're betting it's going to go up, they're betting it's going to go down, or vice versa. So that is absolutely true. Now, the question is, who is causing the pressure on the market? In other words, it's the same question that you have with markets. You always hear the quip, well, there's a buyer for every seller, and that's true as well. So if that's true, then how do you account for price movement? Well, because the pressure of the sellers can be more aggressive than the pressure of the buyers. Now let's look at the silver contracts for an example. So let's say that you have 10,000 more short contracts, okay? So we've currently got 98,000 the open interest, and all of a sudden, let's say JP Morgan wants to dump 10,000 contracts. Now, there's going to be people out there who are willing to take the other side. Some of them are going to have bids that are below the market. Some of them are going to have bids at the market. Generally, if 10,000 comes on the market, then real quickly, for example, it's going to push the price down. Now, the question is, who's on the other side? And the answer is, a lot of times, the people that are on the other side are speculators. Those speculators are not necessarily bullish or bearish on the commodity. They're just simply trying to make a spread. So most of the time, and I'll show you in stocks, options especially, most of the time they're using offsetting positions. So let's go over to the SLV options, and we'll use that as an example. So you can see this is the current options for the SLV, and this is the July 12th contract, and you can see that expires on Friday, July 20th. Not a lot of life left in that. Just a couple weeks left. So let's go down and look at the first one here, the calls. Let's go down and look at the 30 calls. And you can see here we've got about 50,000 open interest on the calls for the SLV 30 strike. So you got 50,000 contracts betting. Well, these are for 100 shares in the stock contract, but you have 50,000 contracts for 100 shares each, betting that the price of the SLV will be above 30 by that date, July 20th. Now, if we go down to the put options, you can see on the puts that there's only 15,000 for that 30. So you can see the variation in these numbers here of open interest. You got this huge outlier at 50,000. You got a couple 23,000s. You've got the 2850 here. There's only 5,000 people. The 28, etc. And you'd think normally the bulk is at the money, and you can see the price for the SLV right now is 27.50. So if we look at the 27.50 calls, there's only 1,600 of them there. There's 15,000 on the 27s. So the big bulk is up much higher here. Now, what accounts for that? That's why I'm looking at this. What accounts for that huge number? Well, that's somebody taking a position. Now, if somebody comes and takes a position and says, you know what, I want 30,000 calls on the SLV because I think it's going to go up through 30 in the next 2 weeks. And of course, these go back months and months and months, so it might not have happened recently. Now, when they do that, somebody on the floor is going to take the other side of that trade. Now, that's going to leave them highly exposed to an adverse move. So what are they going to do? They're going to offset their position. So they're going to go into another contract, another option, and they may go with the put instead. There's a million things they can do. They can go to another price. They may have sold the people who wanted to buy these calls here, sold them 10,000 calls there, but they might buy 10,000 over here at this price. Or they may buy the futures, or they may, there's just a million things they can do. Now, when they do that, when they take the other side, let's go back to the futures market. In the futures market, if they're going to try to offset, let's say they took 10,000 contracts from JP Morgan and they took the other side, so that means they're long 10,000 contracts. That means they're exposed to a price decline. How are they going to hedge that? Well, the way they're going to hedge that is they're going to short something else. So that generally puts pressure on the price. So that's how that works. If these people are manipulators who put in the 10,000 short contracts, and the other side are just people who are trying to make the spread, they're going to tend to offset that position. That's going to depress the price as their offsetting positions works its way through the market. So just because there's the same number of shorts and longs, first of all, that doesn't mean that there can't be price pressure on the downside because of those offsetting positions. Secondly, that does not mean that the people who are long are actually interested in being long. They might be terrified that they're going to get destroyed by another price suppression crash like we had in May or September, and they're going to run out and hedge themselves. It's not that they're interested in being long silver, or especially being long paper silver. It's that they're trying to make a small profit by locking in the spread. So I hope that's an explanation. It's not a question of who the longs are, but it's a question of how much pressure is on the market, who is it being created by, and clearly in the case of silver, it's paper shorts. The other point I wanted to point out with the COMEX, you have to remember, I pointed this out many times, that FOFOA pointed out originally, that the COMEX only delivers 5% of the physical silver that's used in the world per year. So the COMEX trades an enormous amount of paper, but as far as physical delivery, it's barely even relevant. So a lot of those offsetting positions are also offsetting positions in paper. It would not surprise me at all if many of these long and short contracts are then offset in the SLV, whether it be SLV shares, whether it be SLV options. And so it's there's a lot of ways for those positions to be offset. But if somebody with big dollars is betting a whole bunch of money against silver, shorting it, then that's going to cause pressure throughout the market by all the offsetting contracts and positions that the people who take the other side are required to take. So hopefully that makes that clear. Back to silver, we're looking for a rally, and I think we're probably going to test 30 again before we go lower. I'm guessing that we're not going to go lower anytime soon, but who knows. So the first test is going to be this 28.50 if we can get through there. Next is going to be 29.50 with that next downtrend line. And then of course we're looking for 30. That's where the major resistance is going to be as we come back on the way up on this one. And we'll talk to you next time.